Welcome to the Financial Advocacy Podcast. I'm your host, David Kinder, the tax-exempt wealth guy, registered financial consultant, and chartered life underwriter, and my co-hosts, Michael Moffat and Kurt Gibbs. This is a disclosure where we say you can't hold us accountable for any actions you take on your own, just like all financial entertainment shows. We are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Let's get started. All right. Hello and welcome. David Kinder here. And for some reason, it's not going to Instagram. Oh, darn. Okay. Well, I tried. I wonder if I could just do it right now to LinkedIn and just, hey, there we go. We're on LinkedIn. All right. Go figure. Well, welcome back, Mike. We're, what week are we on? We're on week 4. Week 4 of financial literacy. We're just getting back to the basics of financial planning and all these decision-making things that all these things that we all have to figure out as adults that usually don't get taught in high school. And I'm hoping that somehow it gets out. Alonzo, salute to you. Can't wait. Streaming. Yes, I appreciate you restreaming, Alonzo. Appreciate you, my friend. So this week we are talking about insurance matters, and Janet, we're going to keep this high level and at the same time on the basic side. There are some exotic ideas of insurance. There are some really intricate things. We're probably not going to go there just yet. Might be a little stringent or something in there every once in a while, but when we first get into adulthood, what kind of insurance policies do we usually start off with? And the first thing I think of is auto insurance. You buy a car, you typically borrow money to buy the car, and the lender then requires you need to have insurance on that car just in case. So we're starting off the property and casualty module, more or less. Let's talk about auto insurance. Can you take 15 minutes to save 15% on your auto insurance? Is that really how it works?
Yeah, maybe.
Maybe, right?
Depends on, I guess,
depends
on your driving record, right? And your credit and all the other stuff that they pull when they, run your car insurance.
Yeah, there's the underwriting process, and then there's the coverage process. And the fact is that you can almost always find ways to cut your coverage and cut your premium. I don't think there's any really big deals out there for auto insurance. However, there are some really outlandish premiums out there. I remember, this is like 25 years ago. I had my new car, and my new car at the time was an 03 Toyota Corolla. And of course, I financed that sucker. And I think I got a quote from AIG at the time. And AIG quoted me, I think it was like $4,000 a year. I was like no. And when the premium is so high, what are they really telling you? They're telling you, we don't want your business, but we'll take it. But if we're going to take it, we're going to charge you up the yin-yang for it.
Well, I mean,
that's what it is.
It means that they consider you a high risk, right? It's the same thing with all insurance. So
yes,
the higher the risk, the higher the premium. So you're not going to be a high risk and get a low premium. So the two kind of go hand in hand.
Usually, but at the same time, it's like, yeah, that was just unacceptably high, obviously. And they were pricing me out, basically saying, we don't want you. But if we're going to take you, you're going to pay for it. And what would you be paying for? The name, the name on the policy, really. And, the claims paying ability of that company. We'll give it that. I think I went with 21st Century. Far less. I think it paid like, I don't know, $1,200 for the year. Something like that. Maybe $1,500. Somewhere in there. Far more reasonable. It was like $120 a month. Whatever that worked out to be. But okay, I can deal with that. But auto insurance, when you have a financed car, whether it's a lease or purchase, you're going to be required to have auto insurance. And not only that, the state requires it. If you're going to be on the road, if you're pulled over, if you don't have insurance, yeah, you either get a ticket or they might just say you can't drive your car. We're going to tow it because you don't have insurance. It depends on your state and however how generous the officer is feeling that day.
Welcome back to the It Depends podcast.
Yeah, that's. I was going through all my notes. I'm like, no, we keep saying it depends. So yeah, but it's true. But as far as the pricing of it, not just the underwriting part, but how we structure our coverage. One thing is that if you have a financed car, you have to have a couple of things on there called comprehensive and collision. And those are coverages where basically if something happens to your car, depending on either you're in an accident, that's the collision, or someone stole your car, that's the comprehensive part. That's the part where they come in and they help to either replace or fix or whatever it is on the car. Now, if you own your car outright, you don't have to have that coverage. But keep in mind, when you don't have certain coverage, you are self-insuring, or rather, self-insuring assumes that you actually have the money. It just means you're retaining the risk. And I should have started off with this. All insurance is about a transfer of risk from ourselves to the insurance company or whatever way that you're managing that risk. It's a transfer of risk almost all the time. And if we don't keep that in mind, then sometimes we lose sight of what the insurance is really for. And that's not really the case for auto and homeowners and stuff. That's pretty cut and dry. There's other uses of insurance where it's like, are you trying to sell that as an investment or is that really insurance? Tell me what you're really trying to do. There's a lot of things to that. So it depends, my brother. And yeah, your PNC guy sometime happy with it. Awesome. Well, hey, we got to cover the basics here. And comprehensive and collision is not full coverage, which is annoying because they often don't offer the things that help, like loss of use or medical payments. Yes, those are separate.
Yeah. So Alonzo makes a great point. So and this is something that isn't talked about a lot, but just because you have comprehensive and collision and just because you have whatever else, it doesn't mean you're fully covered, right? And especially with liability is the biggest risk that you can have. So even if you have your car paid off, you still want to have the other stuff most likely because liability is only going to cover the other person's losses. And if you get in a wreck and it's your fault, well, guess what? You're on the hook for a lot and it could really add up quickly. So it is true, right, that having full coverage is always going to cost more than having liability coverage only. But you have to weigh the risk cost of that, where if something happens, you're going to be the one on the hook, not the insurance company. And just having minimum coverage, I don't think it's good enough. You gotta think about it. You want to protect yourself. Now, you don't necessarily need to be overinsured either and have necessarily maybe the highest coverage that you can get, but you don't want to be underinsured and just get the bare bones liability or the bare bones comprehensive and collision either. So there is maybe that happy medium where you're getting good coverage, but you're not necessarily paying out the nose for it either, where you have
let's talk about what the real liability could look like. So far we're talking esoteric terms, right? So let's make this real. You're in a wreck. It's your fault. Okay. We're just going to say that up front. Now, by the way, whenever you have an accident and the police come over, they're taking the report, you'd never admit fault. You might tell what happens, but you'd never admit fault because that could be used against you in case you're sued, right? But let's suppose worst case scenario. You hit somebody, you killed somebody. They're dead. Now, who's the person? Let's make up a scenario. Young dentist, 30 years old, young family with 2 kids. How much are they going to sue you for?
As much as they can.
As much as they can. And there's actually a formula for that. Yeah, there's a formula for that. And it's going to be based on that person's human economic life value.
Correct.
And that's the technical term. It's a calculation that's used. In fact, there's a calculation used. I'm skipping ahead because we're going to cover life insurance last because it's the most misunderstood type of insurance out there. But that's the calculation that was used for 9/11, when the people who were killed in 9/11, and they were ascertaining how much should the government be paying and such. That was the calculation. Human economic life value. It is a real thing. Now, so you killed somebody, they're going to sue you. Now, if you don't have liability coverage, they're coming after you. I don't know. This is a legal question, and I am certainly not an attorney. Neither are you. Can you bankrupt that liability? Is there a way to get out of it? I mean, the fact is, if you don't have the funds, they can't collect you can't collect blood from a stone, right? So if you don't have the money, what's going to happen? I don't know the answer to that. I don't want to find out the answer to that other than to just ask a hypothetical question, So you don't want to get in the accident, but if it happens, you killed somebody, they're coming after you. They're going to sue you for it. And of course, if you don't have enough coverage, that's the problem. And so, but at the same time, how often does that happen? Not very often, which is why auto insurance is generally profitable for the insurance company. Because if it's not profitable, if they can't make a profit doing it, they're not going to offer it. And we can talk about insurance companies and stuff for property casualty and homeowners, especially for California here. But that's a little bit more of a current event thing. We're not going to, I want this to be as timeless as possible. So, but here's the interesting thing is, depending on your deductible on the policy. Now, what the hell is a deductible? And no, we're not talking about tax deductions. A deductible is an amount you actually self-insure for, which means in order to get the benefit, you have to come a little bit out of pocket to have the insurance company pay you the remaining benefit. So if your deductible is $500, that's all you need to come up with out of pocket. And that helps alleviate frivolous claims, right? If someone broke your window and you can replace your window for $200, you don't need to file a claim, right? You just pay for it. Because if you try to file a claim, they're going to say, well, you've got a $500 deductible. Just do it. Although I did replace my windshield last year, and the original glass was going to cost another $700 on top of the aftermarket glass. So I just did aftermarket glass and called it done. But what's interesting with the deductible, think about how many times have you actually used your deductible? And if you haven't really used your deductible, then figure out if you increase that deductible from $500 to $1,000, how much money might that save you each year? Now, let's suppose it saves you $50 a month. Okay, that's not a big deal necessarily, because remember, what you're doing is you're retaining more risk in the event of a claim. So if you're able to save $50 a month, that's $600 a year. Now let's do the math on this. I was paying, just in this example, and I'm pulling this example out of my head, so don't quote me, check your own policies and everything. Don't change anything without doing the math. But if you could save $600 a year, and what you have to do is retain an additional $500 more at risk, that's $600. Whose pocket is it better off in, theirs or yours? That one change, keep all the rest of your coverage the same, increase your deductible. Now you've got more money in your pocket. That just the one change. And that's assuming that you've been a safe driver, that you're defensive. You've got to know your limits and stuff. So it's something to keep in mind that someone is really stuck on, planning for their future. Where are you overspending now? And some of it could be in insurance coverages, and you don't have to sacrifice a whole lot to make this work. Make that one change. You free up a little bit of money, and then you can put that where it's best serves you for the long term. I think that covers auto insurance pretty good there. Pretty much. Hey, you taught the thing, but we're not teaching people how to pass the exam. You taught property casualty.
No, we're not. Yeah, we're not going to go that in depth, but obviously you can add towing and all kinds of stuff to it, right? So just keep in mind, anything that you add to the policy, of course, is going to cost a little bit more, but sometimes a little additional cost can be worth it. So you got to always weigh the pros and cons of these things. Yeah,
you just got to weigh it out and figure out, is that important to you or not? Also, don't duplicate your coverage. So, for example, roadside assistance. If your insurance company is offering that, but you also have a AAA membership, don't pay for them both. And by the way, I'd rather have AAA than I would, to have it through the car insurance. So, that's what I'm thinking of. So make sure that you understand what you already have. And believe me, I'd rather have AAA than whatever from whatever.
Next topic.
No vicarious liability. Hey man, all right, Mike, if you know what that means,
I don't know if we need to go into all this. We're just touching on the basics. I don't want to get too into the weeds here.
This is basic financial. This is not how to pass your insurance exam 101. And by the way, just for the record, I am not property casualty insurance licensed, but Mike is and has actually taught the course in the state of Illinois. So that's one reason why I don't mind.
If you have a question about vicarious liability, reach out to me after the podcast, and we'll go into that.
There we go. We can figure that out. So yeah, Alonzo says he recommends 100, 350 limits, and yeah, thank you, Alonzo.
Yeah.
I have your permission, my friend. Anyway, homeowners insurance. And of course, in terms of recent headlines, I said I wouldn't do that, but homeowners insurance has been a big deal in California for a long time. Especially recently, we've had these massive fires that have caused a whole lot of issues. And right now, the state of California is trying to regulate to make sure that the insurance companies are really going to pay out. Well, let's not get into my regulation rant, because really they're creating a whole lot of problems that really should not have been going on. But homeowners insurance, what does it cover? It covers the cost of rebuilding your home. It's the structure. Do you really need to insure the land? Probably not. But you need to make sure that you have enough coverage to make sure that, that there's the cost of construction and all that other stuff. So you got to make sure you're actually paying for the coverage you actually need, and maybe a little bit more, but you need to make sure that you've got enough to cover what it's supposed to do. Also with your deductible, if your homeowner's insurance deductible is $1,000, what would happen if you increased it to $2,500? Would that be worth it or not? You just got to figure out and do the math, if that makes sense. And if it makes sense, you can put that money back in your pocket. If it doesn't make sense, then don't do it. But keep in mind that, if you got like a flood or you have your hot water heater, whatever it is, whatever's covered by homeowners insurance, if you've got a claim, whatever the deductible is the amount you're self-insuring for. That's on you. So you can actually negate a lot of frivolous or smaller claims, which in turn makes the insurance company a little bit more profitable because they don't want to process the small stuff anyway. I think that's kind of it. We don't have to go over a whole bunch of homeowners insurance, although making sure that, if you need earthquake coverage, fire, flood, that kind of thing, you got to determine your risks in your area.
Most homeowners insurance policies are going to cover the basic things like fire, flood, things like that, wind, hail, all of those things. So they're generally going to cover that. There are different types of homeowners insurance. There's also renters insurance, and in case you're renting or things like that. So and they're going to slightly vary from policy to policy based on the type of homeowners coverage you get or renters coverage that you get. So again, if you want to go more into detail, feel free to reach out. I'm more than happy to discuss that with you guys. But yeah, I mean that's a general idea that you gave. So I think that's pretty good.
Now, one of the best things to have, by the way, in terms of making a claim. So if you have an earthquake, fire, flood, whatever it is, you need to be able to prove that you owned what you've got. So one of the best things you can do is and everybody has a phone. And if you don't have a phone with a camera, I hope you're working for the government and get another phone and videotape your stuff. Have a video record of it, including the receipts. If you can document all that stuff, and especially if you have receipt now, even if you have the receipts, stored in the cloud, which, the cloud is better than, in the file cabinet that probably got burned. But, if you could document everything that you've got, that much the better to help show legitimate claims that, for the stuff that was lost. So that is a great risk prevention practice. And as far as where to store the video, you can keep that video on YouTube. And on YouTube, I mean, you can keep it in a private mode, put it in Vimeo. You can just keep it in the cloud, whatever you need to do so that it could be referenced if and when needed. And maybe you do it once a year. You go through your house and you just update everything and, label them by year. Here's my 2022, 2023, something like that.
The one thing I think is important to talk about is replacement cost versus actual cash value, right? So
Oh, yeah.
we want to make sure, I mean, in most cases, you're going to want to insure for the replacement cost because that's going to be whatever the cost is to replace the item new, basically, whereas actual cash value takes into account depreciation. So they'll give you the whatever the cost initially was minus however many years of depreciation there was if you file a claim. So in essence, you could be getting almost nothing back if you have actual cash value instead of a replacement cost. So of course, replacement cost is going to cost a little bit more, but maybe it depends on your situation and what the item is that you're insuring, but for most homeowners policies, you're going to want to get replacement costs because you're going to want the insurance company to replace it with same materials like new as if it were just built.
Yeah. And oh man, the thought just so here's the thing is that, and think about like a car value, right? And obviously a car is covered separately, but if you wanted the actual value of the car, I mean, do you want the car or do you want the check? And you might get the check, but the thing is that you're not going to get the market value necessarily. You're going to get probably the Kelley Blue Book value that it says that you're going to get, which will probably be lower because we've been in a weird used car market lately, right? Used cars have been much higher in value. And so I'm looking at that. I'm like, they're not going to pay you any more than they have to. Now, if they don't pay you as much as you think it's going to be, you sue for it, right? And you never know what's going to happen. And I know insurance attorneys, their job is to sue the insurance company to make sure that, claims are basically that the policy owner is better taken care of than they originally planned. But, if you have the right coverage in the first place, it should be, that's the keyword, right? There's the independent, it depends, now should be an automatic thing. So we'll see. Everybody's experience will vary. So we'll go from there. All right, Mike, I guess here's a quick question for you. What's umbrella insurance?
So umbrella insurance is just going to cover, think of it as you can put a bunch of things under an umbrella, right? So your business, your home, your car, your this, your that, you can put a whole bunch of things under this umbrella and cover them all at once, as opposed to getting various separate policies. Is a pretty simple way of explaining it.
Yeah, pretty simple. And the limits are far higher.
Correct.
On these policies. And so, like we mentioned earlier about, if you hit someone, you killed them, and they're going to sue you. Well, your auto insurance has a certain limit, right? Well, what happens for limits above that? If you have an incident above that, what's going to happen? If you have an umbrella policy, it can cover that up to a new limit. So maybe you've capped out at $500,000 of coverage for your auto insurance. Well, maybe get a $5 million liability policy. So that helps to cover the difference, whatever that gap is going to be. And so Alonzo says additional liability is how I explain it. Yeah.
Right.
That's just essentially it, just to make sure that you're covered. And the idea of it, in order to get it, you've got to have the maximum base coverage first. You can't get umbrella with state minimum coverage and then add you've got to have the maximum coverage. And of course, in order to do that, does that make sense for you?
Typically people with umbrella coverage are going to have assets that are of a high value that they're personally high net worth person that's afraid of being sued in the case of an accident or what have you.
Of whatever, or someone slips and falls outside of your home, right? Now somehow you're responsible, even though it maybe happened on the pavement, but it's like, come on, just it's your job to have better shoes, that kind of thing. 250, 500, 100 limits of liability. There we go. So so that kind of covers property and casualty. We could cover commercial insurance, but we'll do business in a whole nother session. We're just keeping this basic.
Yeah, and we're really more focused here on individual, personal stuff and not necessarily business related, but we can do a separate one on that too, for sure.
Yeah, well, business are people too.
Well, businesses are businesses. People own
we're
business.
gonna have fun on that one then. Okay, so let's go to our next section. We're gonna go through the boring stuff. So group group insurance, employer insurance plans. So when we finally get our real job, they let us enroll in health insurance. I am not an expert on health insurance. Ever since they went to these health exchanges and everything, I don't know nearly enough. I know that there's three basic types, and maybe there's probably more now. You have your HMO type of a health insurance plan. HMO is a health maintenance organization. The whole idea is to help you maintain your health, which means you're going to be able to see them for your routine stuff. And it's priced a little bit better for that. But you can only see the doctors that are in their network, whichever company it is. And most people have an affiliation. No, that's not the right word, but they like their doctor. They want to keep their doctor. And if you want to keep your doctor, you got to make sure that your doctor is in whatever company network that you're enrolling in, which some reasons, like why some companies have like 10 different health insurance companies. Yeah, but the bigger the company, the more choice you might have. And so you got to pick which one's going to work well for you. But HMOs, they have low co-pays, but they usually have very high premiums by comparison.
I would say that it's the opposite.
The only thing that saves it is that you have to stay within their network.
Yeah. So typically, from my experience at least, HMOs are also going to have a lower premium because it's a managed network, right? So they're managing the network, so your cost of insurance is going to be lower. Whereas if you have a PPO, you can go anywhere,
right?
And in or out of network. Of course, keep in mind, PPO is a preferred provider organization, and
right,
you do have the ability to go outside of your network. However, the deductible typically is going to be, in a lot of cases, twice as much, right? And the copays are likely going to be close to twice as much too, even after you meet the deductibles. And just a kind of a point of contention that I have with these things is that HMOs have gotten a bad rap over the years for whatever reason. But let's really take a step back and think about this. If you have a PPO, how often are you going to want to go out of network and pay twice the cost to go out of network? So if you're getting all your coverage in the network and the HMO covers it, why pay a lot more for a PPO? And not only that, but everything's always covered in an emergency anyway. So there are situations for sure where an HMO could be very beneficial. I know people get scared by them and what have you, and because they have to stay in this managed network, but it's always covered in an emergency. And as long as your doctors and hospitals accept the plan, and if you have a PPO and they don't accept the plan, are you willing to pay twice as much out of pocket to maintain that? Maybe you are. That's a personal decision, but just something to keep in mind. And I know HMOs, like I said, have gotten a bad rap over the year, but I don't think they're necessarily as evil and awful as people make them out to be, especially if most of the doctors and hospitals in your area are already covered by it. So what was the third one you wanted to mention besides HMO and PPO?
The third one would be POS. And that does not stand for piece of. It's never point of sale. It's the same kind of thing, but yeah, I think it's even lower cost, but yet higher deductibles. You got all that freedom. It's a whole different kind of a thing. And again, I'm licensed in health insurance. You can tell how versed I am in it. I don't do health insurance. I know it's enough to, you get your benefit enrollment book. Let's go through it. You just got to weigh it out, figure out what you want.
Going back to your original point with employer plans, most employers now are structured, like you said, with these different levels of coverage. So typically you're going to have like your gold, silver, and bronze plan. Some places might have a platinum plan, and some, and then you might have like a HSA, high deductible type plan. Obviously, the platinum and the gold are going to be the highest premium, right? But they're going to have the lowest out-of-pocket cost when you go to the doctor. So if you're somebody that maybe goes to the doctor all the time, it may be worth it to pay that higher premium to not constantly get nailed with, out-of-pocket expenses, and your prescription drug costs are probably going to be lower under that because you're not going to have as big of a deductible. So, and I know some people that I've personally enrolled in plans that they're perfectly healthy, but they still pay for the expensive coverage just in case something happens to them because they don't want to have a giant deductible that they have to come out of pocket for. So there's the pros and cons there. And of course, if you have an HSA, that's a nice thing. You know, that's the triple tax benefit thing, right? So you can get, if you're healthy and you think you're going to be okay and you want to get a high deductible plan with an HSA, go for it and, you know, contribute the maximum allowable or that you can to the HSA and start building that thing up. So that way, God forbid, when you have an event, you have some money put away to help pay that gigantic deductible and out-of-pocket expenses you're going to have.
Let's translate HSA. So HSA is a health savings account. You can set them up just about anywhere. And the idea is that you put money in tax deductible. The money that stays in the plan from year to year grows tax deferred. As long as you pull the money out for qualified medical expenses, it comes out tax free.
Right.
So, and when it's coordinated with an HSA eligible health plan, then you've got all kinds of other benefits because you're coordinating a health insurance coverage with that tax benefit. So does it make sense? Like anything, talk to someone who knows. Mike knows. It's not my wheelhouse. So, but that's usually the first area. Now, the second part is dental and vision. I've heard from someone else who's been in the health insurance field for a long time that dental is a ripoff. I'm like, well, okay. The worst case is that you've got to, I'll get back on that rant in a second. Does health insurance change based on if it's an individual or family plan? It absolutely does. Here's what's interesting, though, last I remember, is that if you have 1 kid or 20 kids, it doesn't matter. They're all priced the same. So as far as your health insurance is concerned, you can have as many kids as you want, and the premium does not change. But it does change if it's by yourself, if it's you and your partner, spouse, whatever. And then once you have kids, so there's 3 different levels of premiums there. So by yourself, married, or married with children. Right? I don't think that's changed any. I have I keep it so separate. I don't even pay much attention to it. But dental, I mean, you pay for your checkup. If you need braces, but that's orthodontic stuff, not necessarily dental, so it's a little bit separate.
So dental can include braces. Now, here's the thing. Typically with dental is the kind of thing that nobody wants it until they need it, right? So
yeah,
with a lot of dental plans, and then once they pay the claim, a lot of people want to cancel it because they don't want to pay the premium anymore. So with a lot of dental plans, what you're going to see typically is there's going to be what's known as an elimination period, right? So it's going to have a period where you have to wait a certain amount of time before it'll cover XYZ procedure, whether it's a root canal or dentures or, whatever it is that they're going to pay for. And, I had an example of this I saw in an insurance forum the other day. Somebody posted about a dental plan. Somebody wanted to get dental for that exact reason because they wanted a root canal or something covered. And I'm like, well, you're a little bit too late because they're not going to just, for that. Yeah, you're not going to pay your, I don't know, let's just say $40 monthly premium, and then they're going to shell out $1,000 to pay your root canal and then let you cancel the coverage right after. I mean, that wouldn't be smart by the insurance company. So dental, it can be nice. I mean, typically with your dental, you're going to get your 2 free cleanings a year, your 2 x-rays, your stuff like that. You have to weigh the cost of the premium versus how much.
We're doing that again. We got to keep weighing everything out, figure out if it makes sense for us. It's that it depends garbage we keep saying, right?
I mean, you got to weigh the cost, right? Versus what it would cost you otherwise to go get that cleaning and x-ray done twice a year. The other nice benefit is that once you have it enforced for a while, if something major does happen or you want to get something done like that, then you get rid of those elimination periods and it'll be covered immediately instead of waiting until you do have a major expense or something happens to your teeth. So there can be benefits for it. And plus, if it's coming out of an employer plan, it's going to be taken out pre-tax. So you get a little bit of a tax savings on that. So it just depends.
And the employer may be matching the premium on some level too, maybe 50% with you. So it depends. I know that often happens for health insurance. The employer may pay 50%, maybe they pay
or a
75%.
lot more.
It depends. Maybe they'll just cover it. Who knows?
Yeah.
But it's important to take a look and verify. I had it off the top of my head, and I hate it when it disappears. But this was it. Basically, what you mentioned is that if you already had need a root canal, and now you want coverage, one begets the other. You need the coverage in place first, because essentially, and this is a great rule to always keep in mind, you can't insure a burning building. You can't get life insurance when you've been diagnosed with cancer. You can't get life insurance when you've got other, you need heart surgery. You're probably not going to get approved until after the thing is done, and some time has passed. Same thing with your health, same thing with your dental, all of that stuff. You can't insure a burning building. You can always ask, and better to ask and find out. But still, generally speaking, once you have a diagnosis that's a qualifying diagnosis that basically says you're going to have to wait, or you come out of pocket, or whatever else. So every type of coverage is different.
Dental is very similar to vision, right? Nobody wants to buy vision insurance until they need, glasses, or something happens to their eye where they need surgery or something like that, and like a glaucoma or something. So nobody really wants that. I mean, vision insurance, generally speaking, is pretty inexpensive. So certainly if you're like us and you wear glasses and you have, coverage for your glasses in there, and it's only a couple bucks a month, and you go get your eye exam every year and maybe get, new glasses every other year or something like that.
And you might get a slight discount on the glasses that they make available. I mean, there's different things that they might do.
Right.
So,
of course, it's going to be, and of course, there's going to be different levels of coverage, maybe even within your vision policy. Same with your dental plan too, right? You might have a basic and an intermediary, and then like a more of a platinum type coverage where it covers more. So again, it depends.
And here's a hint: if you have a hard time reading the coverage, you probably should get the coverage. I'm just throwing that out there. That's a terrible joke, but I'm just saying, if you can't read what it says, you probably need to get it. Okay, couple other parts for group and employer plans is that one of them is disability insurance. Now, in California, at least, we have something that shows up on our pay stubs that says CAOASDI, and that's old age social disability, something like that. I don't remember what it stands for necessarily, but it's something like that. And it actually pays into a disability plan for being a citizen of the United States. Well, actually, I don't think you have to be a citizen in California. I'm just saying. But when you're an employee, and if you get hurt on the job or something, it's not just workers' comp, but you actually can claim a disability benefit from the state. So the state has its own, and it does take a premium from every paycheck. Now, I don't know if that happens to every state, but I know that that's part of it. But that's a state-provided plan that's mandated by the state for every W-2 employee, not necessarily an employer plan. But if an employer offers additional coverages, you might want to get it. So, for example, life insurance. Employer-sponsored life insurance is the cheapest insurance you can ever get anywhere, period, bar none. So what's the problem? The problem is you can't take it with you. More than likely, you're going to leave the job at some point. You're either going to retire from it or you're going to quit it, whatever it's going to be, and you can't take that coverage with you. And the reason is because you get a certificate of coverage that says you are part of their policy, but you only get to have that while you're working for the company. Once you leave, there's no guarantees. Now, there's a couple of companies that will offer retirement life insurance. And we've seen in recent headlines, I was studying this not too long ago because I'm putting together another course, but like Alcoa and Sears, they both terminated their life insurance benefits for their retirees. And so just because you had it doesn't mean that it's always going to continue on. It's not an individual policy. You get a certificate of coverage that says as long as, the terms are met or whatever, then you have coverage. Other than that, you don't. So it's not really yours. You just get to participate in whatever the company says you get to have. But the good news is you could typically get $25,000, $50,000 of coverage in the event of your passing. So, I mean, and it's pennies.
It's very cheap, or in some cases, employers will just give it to you for free.
Yeah.
So if that's the case, then definitely take it. And I wanted to go back to the disability thing because
Okay.
I feel like this is a really overlooked coverage, right? So most people think, oh, well, if I trip and fall on the job or I get hurt or this or that, I have workman's comp. Well, that's true when you're at the job, but you only spend a third of your day roughly at work. And the other 2/3 of the day, you're not covered at all. And if you fall at home and get hurt, or you get in a car accident, or you get something else happens, and you don't have any short-term disability, maybe you have a week or two of vacation time that you could take, or what have you, where you can fill in the gaps. But if it's anything longer than that, and you don't have any kind of short-term disability, that's going to be a big problem. And generally speaking, depending on, again, the elimination period, how long you wait to receive the benefits, like if you have 2 weeks of vacation built up or a week or whatever, you can push your elimination periods out a little bit further. That's going to make your premium less expensive, of course. And then you're going to have the coverage. Now, of course, they're only going to let you cover so much of your income because they don't want you to never come back to work, right? So I think the number is somewhere around 66% of your income or something like that you can replace.
Yeah.
So,
and those benefits are generally tax-free. So if we think about a maximum tax situation, which usually this isn't that situation, but if it was a maximum tax situation, essentially you're getting the same net income after tax.
Right. And your employer, make sure your employer is taking, if you have short-term disability, make sure they're taking that premium out after tax so that the disability when you receive it is not taxed.
Now, you brought up a great point, and I'm going to get to Alonzo's comment here in a second, but you're assuming eligible, legal, proper claims for someone who got hurt off the job. Employers, how many times do you have an employee that got hurt off the job that decided to file a claim that they got hurt on the job so they can collect workman's comp instead of taking the consequences themselves? So this could be a way to help ensure that there's some kind of coverage that they can get that far quicker than a workman's comp claim and keep your premiums low and less frivolous claims. So that's an important consideration. And here, I'm going to throw this out there. If you're an employer, are you covered on your own workman's comp? You're probably not. You're probably automatically excluded. So if you get hurt and you can't work for 3, 6, 9, 12 months, where's your paycheck going to come from? So there's that's a whole different conversation, but it's all related into that injury. And that's by just injury. We're not even really talking about illness, because when an illness happens, illness is far harder and it takes a whole lot longer to recover from than an injury. An injury, 3 months, maybe. You break your leg, 3 months, right? Maybe 2. Just depends. Okay, so Alonzo said right before we went on to our disability diatribe here, employees often get confused with employer-provided life and accidental death and disability. Yes. No, not disability. Accidental death and dismemberment.
Get it straight, Kinder.
Sorry. Jeez. Okay. So years ago, like 12, 13 years ago, I worked for a supplemental health insurance company, and we had an accident plan. And when they were training us, they said, what does an accident plan cover? And it basically covers anything that's violent and external to the body. So, and Alonzo, you know this better than most. I know your story, my friend. If you get shot, that could be an eligible claim. Okay. So if you died in a gunshot, that can be paid up by accidental death, assuming that you were not committing a felony yourself. Okay. You cannot get benefits paid to a beneficiary if you were the one committing a crime. That much is certain. And all that stuff will be documented on a death certificate, all that stuff. But so that's accidental death. You fall off a ladder, that's accidental death. As long as it can be proven that was accident. Dismemberment, you lose a limb. You
lose an eye.
It's 25 cents. Okay.
25 cents, not 50 cents.
Not 50 cents. Okay.
I mean, right.
Yeah,
So
dismemberment.
yeah, you lose a body part, right? Arm,
Yeah.
leg, finger, toe, something becomes dismembered from your body. Anything else is going to be an accident. So whether, that's like you said, falling off a ladder, car accident. Now, the interesting thing about a lot of these AD&D policies is that a lot of them will pay out an additional sum if it's something like a car accident, and some of them will pay out even twice as much as the face value if it's what's known as a common carrier. So that's a plane, train, bus.
Oh, yes.
Something you buy a ticket to get on that's professionally driven, right? So any kind of a commercial vehicle, right? That will pay double. Sometimes it'll pay double indemnity for those, is what it's known as.
Right.
So, and like I said, sometimes car accidents, they'll pay up to the face value plus 40 or 50% of that, depending on the policy you have and how it works. But yeah,
a double indemnity. Yeah, okay. So I'm reminded of a John Savage quote. The guy died in 1991, but I remember the quote. He said something about like a whole. I'm relating this to whole life, but whole life insurance with a term rider. It's like, well, it's an automatic double indemnity rider. You die, we pay as though you've been killed. I'm like, that's the way he explained it. But anyway, accidental death and dismemberment. You have to die a certain way. That's the main thing about it. You have to die a certain way, which is why it's so cheap. Now, I keep getting the mailings from, was it Mutual of Omaha? They like to solicit customers direct, not just go through agents, which is a little annoying as an agent. But I get them, we have $1 million of coverage for you. And it would be like $40 a month. I forgot what the premium was, but it's only if you die a certain way. If not, the insurance company gets to keep the money. Okay. So it's not life insurance. Life insurance meaning that it covers both internal and external, right? It's your entire life. Now, there might be some exclusions, but pretty rare on that kind of stuff. And if there's exclusions, obviously they're going to make sure you know it and they acknowledge it on the policy. So maybe there's an exclusion for the first 3 years. If you die of a heart attack, they only refund your premiums, whatever it is, and final expenses. A lot of those, they call them graded policies, where all you get is your premiums back for the first 2 years because you don't quite qualify for the other stuff. So there's different caveats to that. You just got to look at your policy and double check what your policy does. There's one more part. Yeah, next up. So the last part on that one is there's voluntary payroll deduction plans. Now, these are pretty neat, but keep in mind, these are essentially using your pay stub as your checkbook. These are going to be after-tax contributions or purchases of whatever you're signing up for. So you could get the employee benefits handbook and say, okay, you can get your prepaid legal services, and it happens to include a new will set up. You can get your healthcare director, whatever it is. You could sign up for. You could do an IRA enrollment if they don't have an employer plan, which they really should. But if they don't, you can do contributions to a plan. You can purchase individual life insurance, and I mean not the certificate kind where that's a group. It's individual. That's your policy, and you get paid for it out of your pay stub. It just goes through the HR department and is billed that way. There's individual disability coverage. You can get other supplemental health like critical illness, hospital indemnity, accident and sickness, cancer plan. There's a lot of different stuff out there. Question is, what's important to you? And if you can get it, and instead of paying it out of your checkbook, you're paying it out of your pay stub. That's the only difference. And of course, it's very convenient that way. And agents like it because we get to sit in your break room. We give you a presentation. You come in, you enroll one at a time, or you go on the computer and you figure it out, and you're done.
So for those policies, that's something you think of for like an Aflac or a Colonial or, those supplemental insurance companies where they'll come in and they'll sit down with you and they'll say, okay, here's our list of products, critical illness, whatever, cancer, whatever, maybe an accident policy, whatever it is. And they'll say, here's what it is. Here's the coverage. Here's the cost. And then they'll deduct that from your paycheck. And then a nice thing about a lot of those plans is that a lot of them let you keep them if you leave at the payroll rate, right? So whereas if you were to go directly to them and try to purchase those things, they would be more expensive. But a lot of times those companies will let you keep them at the payroll rate even when you leave the company.
Yeah, it depends by the company. I was
Right.
with a company called Combined Insurance. This is the W. Clement Stone company. It was like 14 years ago. Jeez, it's been a while, but I still remember. In 5 minutes, I can show you how you get cash paid directly to you in the event of emergency. It's quick, simple, and hassle-free. I mean, they drummed that into us, and it's not wrong. And they made it very simple to do. And I still remember the accident policy we sold for one person was $15.04 a month, and it covered a whole schedule of different things. They called it W. Clement Stone in his book. I forgot which book it was, but he called it the little big one because a little price, big menu of things that would cover. So if you broke your leg, you get a benefit. If you had whatever, there's a whole bunch of it on there. So the value proposition is pretty good. However, keep in mind that if you're spending a whole lot of money on those other coverages, are you still putting money aside for your future? That's the trade-off there. So sometimes might help someone. We got to get those things canceled because quite frankly, you might not need all that stuff. Now, if you need it, that's great, but we don't know if you're going to need it. But so far, we do know you're probably going to need a plan for some retirement, and you need to figure out what you're going to do for that. So if you're spending $300 a month on insurance coverages that are completely voluntary, is that the best use of your funds? Would that be better off in the insurance company's pocket or your pocket?
Right.
What if we can combine some of that and create a different plan? There's different things. So let's get to my more favorite part, which would be life insurance based individual contracts. And there's a bunch of things that kind of go into that category. So the first one is disability coverage. What is the biggest risk to us as far as our income? And that is our loss of the ability to earn an income. We get, and there's a difference between critical illness and a disability. And don't ask me what all the questions are on all that stuff. But generally speaking, a critical illness is a heart attack, stroke, or cancer. It is critical. It is quick on you. You're probably not going to have a whole lot of warning. Of course, our health is usually a pretty good warning. But aside from that, but a disability claim is when you can't work and you need ongoing care and such. And you're going to be on an eligible claim for however long it is. And what the disability coverage does is it pays you a percentage of income, like we talked about earlier, up to 66 or 70%, whatever it's going to be. If you have state plans, it's going to be coordinated with your state benefit. And you're going to be able to receive that income after an elimination period. So from the time of claim, let's suppose right now, this is February 5th, right? So if you had the time of claim for February, maybe you have to wait 2 months. So you have to wait through February and through March, and you might start getting your income in April. So that's the elimination period. It's a waiting period. And then you're going to get that income for as long as you're on an eligible claim. I think you usually have to recertify it every 6 months. And as long as you're on an eligible claim, you're going to keep getting that income up to the policy's stated limit. So you might only have a 2-year limit, a 3-year limit, a 5-year limit. There's even policies that pay up to age 65. Do you really need all that? It depends. Those damn 2 words right there. But what's also important about disability is some of the definitions. Own occupation coverage is very different and certainly far more expensive than any occupation definition. So what does that mean? If you're a surgeon, for example, and this is why, Guardian is very much known for this. I don't mind saying it. Guardian is very good for medical professionals because they have certain definitions of their terms in their policies to make sure that they cover for own occupation for a certain period of time. So if you're a surgeon and you can't be a surgeon, but maybe you can teach. Well, if you're a teacher, you're not being a surgeon, but yet you're still working. So that works. And so you pay coverage according to that. Whereas if you have any occupation, okay, you can't be a surgeon, but can you work at McDonald's? If you can work at McDonald's, you're not eligible for claim. That's essentially the way it looks. If you can work anywhere doing anything, that is any occupation. So knowing the definitions behind these things so you know exactly what you're paying for is critical.
Yeah. So with any occupation, you're going to have to be pretty much completely disabled and not really be able to work anywhere for it to pay. So,
which is why the own occupation definition is primarily for these high-end specialty professions, and they price it for that purpose. And the underwriting for disability is based on your occupation, and there's different grading levels of different types of things. Believe it or not, insurance agents are not at the highest level for preference. I think we're kind of a mid-level, if that. I always found that kind of interesting. But yeah, that's the disability insurance. Now, the next one is long-term care insurance. Long-term care insurance is when you need someone to help take care of you. And I didn't write them down. This shows how much I really pay attention to it, but it's called activities of daily living. There's at least 7 of them.
Yeah, toileting, bathing, eating, dressing, brushing your teeth, brushing your hair, whatever. It's those basic
managing your medications, transferring. Right. There's a lot of things that if you need help to do those things, you need help with at least 2 out of 7 to be on an eligible claim of those activities of daily living. And initially, when long-term care insurance came out, it was originally based on the rates were originally based on disability. And that was a big mistake, but there was nothing else to track with. So now they have their own metrics. So this is one reason why long-term care insurance those premiums have skyrocketed, even with the approval of the state, because it's just so costly, because we're talking about the cost of being in a nursing home at sometimes, and not to mention the nursing home coverage, but to be able to stay out of a nursing home, which is really what long-term care insurance should be about. It's preserving your dignity. It's making sure that you don't have to have family take care of you. Your family stays your family, not your caregiver. You have someone else that helps with that. And almost everybody is either experienced or knows someone that has experienced some type of long-term care event in their family. So for me, my grandmother, she died when I was 16. So that was 30 years ago. That was a long time ago. But she was bedridden the entire time I knew her. And I don't remember exactly what. I think it was a hip surgery that went bad. Whatever. It was from the time she was 40. So she was a young woman for the time, when she became bedridden. And so my aunt, who was 10 years older than me, she took care of my grandmother. And I think they just had to get through, we're talking about toileting and everything. Okay. We're talking about all of that. And so when you think about that, wouldn't it have been nice if the coverage existed to have someone else come in and do that instead of my aunt? And my aunt was doing this even while she was in high school. Okay. So you never know the burdens that can be there. And quite frankly, if we think about who should pay the premiums on that, and let's suppose that you have an older family member and you're a high earner. Well, if you're the high earner, maybe you have the risk. So maybe you, as the high earner, son or daughter, should be paying for the coverage on mom and dad to make sure that they're covered. And that preserves your relationship, that preserves your time, all of that. So it depends on who has the risk. They should be paying the premium. So that's long-term care insurance. Now, down to my final 2, and I love these topics. So annuities. Recover annuities. Okay. What the hell is an annuity?
Yeah.
Give it a shot, Mike. What would you define an annuity as?
An annuity will pay out X amount of dollars in a general term for a certain amount of years, or it'll allow you to accumulate at a certain rate for X amount of years, depending on the type of contract that you have, with some limits, floors and ceiling, stuff like that. So it just depends on what the annuity is being used for, whether it's an accumulation annuity or an income annuity, right? So it depends. Again.
It depends. Yes. Again, but I think I'll launch a new podcast. Just call it Depends. I don't know. Have it sponsored. But no, I'm not going to do that. Okay. But yeah, an annuity is all about income. And is it about income immediately, or are we deferring that income to a future date? And if we're deferring it, what is that calculation going to look like? And there's so many different ways, but when we think about it, annuities are primarily all about income. If we think about it as anything else, and it can be done for other things. Annuities can be used for principal preservation. right? You have a lump sum that's at a CD at the bank, and you like to earn a little bit better return on that, or actually better interest rate. Return implies investment risk, and we're not necessarily implying that. You could put the money aside in an annuity to earn a little bit better, and it's going to preserve your money depending on the contract, right? So we have fixed contracts and variable contracts. Variable essentially means the money's going to be invested in mutual fund type accounts, which means there's going to be stock market, bond market type risks depending on the asset allocation chosen.
Well, right.
So we
There's
have that.
also the index products as well, which are going to have a floor, right? But they're not necessarily going to have the volatility that a variable annuity would have. They're not going to necessarily have the upside potential that a variable annuity could have, but they're also not going to have the downside risk that a variable annuity could have either. So
Right. So we have the variable and we have the fixed, and within the fixed bucket is indexed because it's a fixed
it's
index.
fixed index, correct.
Yeah. So with the fixed indexed annuity, the neat thing is that, and I'm going to explain this as simple as I can. It's really not that hard on the conceptual part. Basically, instead of earning a fixed interest rate, you give up that interest rate to say, take the same money I would have earned. I want the insurance company to buy stock market options, call options. And if the market goes up, I want a percentage of that. If the market is flat or goes down, I lose nothing. But I'm going to give up my interest earnings so that the insurance company can use their money to do that. And they're going to price that, interest rate crediting according to however they do it. That's how that works. Now, the problem is there's like 140 different indexes out there. It's absolutely nuts. Now, here's the good news. I don't know them all. I don't have to know them all. Thank goodness I don't have to know them all. In fact, my friend Charlie Gipple just put up a video the other day, might have been yesterday, about volatility controlled indexes on these things. I'm so glad I could call Charlie. Say, Charlie, walk me through this again. In fact, you know what? I got a prospect. Charlie, can I just have you zoom in and you can explain it? I don't want to know. There's certain things I want to definitely know, and some things I'm like, I don't need to know it that much. I got people for that. So Charlie's my guy. He knows this stuff backwards and forwards. Glad to know people who know it. But there's so many, and that part can be confusing. In fact, I actually did a video. It's on my YouTube channel about how indexing credit options can be unintentionally misleading just because there's different percentages that mean different things, and it's too easy to conflate them. So it's a whole different thing. But annuities, essentially, you put in a lump sum. They're largely lump sum contributions into the contract. Okay. And the neat thing is they're governed by federal and state law. That's why they're in contracts. Contracts have different properties and advantages than accounts. So when we think about IRAs, that's an account. Well, actually, it's an arrangement. There's different things, but the contract is the contract. And, we're deferring income, we're deferring interest. I mean, the interest gets credited, but we don't have to take it out. Once we pull out the interest, it becomes taxable. That's assuming it's a non-qualified contract, which means the money you put in was after tax. The earnings are taxable, but only upon withdrawal. And when you withdraw, the earnings come out first. It's called LIFO, last in, first out. And there's the other thing, and I don't want to bore everybody on it, but they're slightly complicated, but not really. Everybody's situation will be a little bit different. But the idea is that at some point, you're going to want to turn on income on that contract. And there's either annuitized income, which is when you say, insurance company, flip the switch, just send me an income for the rest of my life, which essentially means if you die in 2 years, they get to keep all the money. If you die after 30 years, you're still getting the same income, whatever that calculation happens to be. That's called annuitization. Everything else is quasi-annuitization, because when we think about the functionality of it, it's a calculation based on, the income step ups and all this stuff. And then, you put the money in for 10 years, and all of a sudden now you're able to pull out this money, but you can't take out more than what they're telling you. Otherwise, you're going to screw up the calculation. So it's a quasi-annuitization because you still have some control on it, but it works the same way. The question is, does the amount that you're setting yourself up for, is that the maximum possible given the insurance company's ratings? So insurance company ratings are critical on these kinds of decisions. If you want a lifetime annuity, I would not get an insurance company that has anything less than an A minus rating. You've got to have an A minus or better. It's got to be a very good company. Now, Alonzo says, yeah, life insurance covers dying too soon. Annuity covers living too long. And the income can either you have lifetime income, you have period certain income. There's all these different terms. The question is, what's going to make sense for you? And depending on how it's being used. Sometimes I'll help people get an annuity for the purpose of buying life insurance, because this will be guaranteed the source funds are going to be there. And I happen to like that. And it's an ethical second sale for me. So, if anyone wants to know, yeah, I've got a little bit of a conflict of interest there, but at the same time, does it make sense for the client? I could secure the funds and secure the funding, for a 10-year period or so. It makes logical sense. I would be crazy not to offer that. Okay, I think I've buried that part. We covered annuities. By the way, pensions essentially are annuities. Social Security is essentially an annuity. You're just buying an annuity. It's a private annuity essentially for yourself using the lump sum that you're providing it with. Okay, go ahead.
No, I think you covered annuities pretty well. I didn't have anything to add.
Oh, okay, very cool. All right. Now, guys, the last part, I know we're running a little bit late compared to our normal time, but the last part is life insurance. Life insurance is the most misunderstood financial product known to humankind because everybody gets a lot of things incorrect. See, I can't even say that right. But I'm going to tell you what the truth and the facts are. That's my job, right? And I'm not saying that not everybody knows enough, but fact is the general public, unfortunately, they don't know enough. And whose fault is it? We got a lot of talking heads out there that have their opinions. They're wrong. We've got a lot of people that publish blogs and other books. They're often wrong. Am I the only one that gets it right? Well, I'm not going to say that because I know Mike gets it right. And quite frankly, I would more often than not trust a CLU holder to know what these things are, generally speaking. But we want professional insurance agents to explain this stuff. So you guys didn't know that was coming?
But I did.
Yeah, you did. But still, let's do the basic stuff here. So first of all, we're start off with, let's see, can we see that? Nah,
term.
Not really. It says
term.
Okay.
Do you have a darker color? Do you have a black or what color is that?
I
Is that
do have black. I was hoping to color code it, but that's okay.
I'm just thinking for contrast, it'll show up better. Yeah, that's much better.
That's better. Okay, so we got term. Term insurance is what everybody starts off with, right? At least that's what we should be. Term is the least expensive to get started with initially. What's the problem with term? With term, the premiums are guaranteed to go up the longer you live and the more you want to keep your coverage. Now, you might say, well, wait a minute. I've got a 10-year term. I've got a 20-year term. I got a 30-year term. The longer your term, the more you're going to pay a premium. But once that term expires, you can have guaranteed renewable, but not necessarily guaranteed level. And there's a difference there. Renewable means you don't have to get medically examined again. Guaranteed level is about the premium. Usually when the term expires, and let's assume you can't qualify for anything else, that premium is going up by at least 10 times. So if you want to keep your coverage, minimum. And I've seen it a little bit higher than that. So it keeps going up afterwards. So the least expensive to get started with. In fact, I'm going to do that because I need more space. And at the end of the term, what do you have left over to show for it? Nothing.
0.
You have a lot of payment receipts. Thank you very much for having purchased the policy. You were a good customer. You kept your payments on time. Thank you. That's all you got. Now, on the other side, we have, don't mind my doctor. This shows that I should be making a lot of money with bad handwriting, right? Max funded life insurance. Now, in this case, I don't really care if we're talking about whole life or index universal life or whatever, because we're talking about the amount of premium for a given amount of death benefit. But this is the most expensive to get started with. The advantage with this, because it builds a cash value, is that over time, your premiums are level. They will not go up, but they can go down and they could even stop based on the policy performance. And after about 15 plus years or so, I'm trying to, for a maximum funded policy, you can get 100% of your money back plus a bank like return, generally speaking. Then in the middle, we've got the hybrids. I can't spell. So hybrids, they're in the middle. They're going to be a little bit more expensive than term, but less expensive than a max funded policy. Premiums can go up, they can go level. I doubt they'll go down, but you never know what's going to happen with them. And you might get all your money back for however long that you have it for. And with this presentation, at this point, we ask, is there any questions? And usually we get two kinds of responses. The first one is, why would anybody buy term? And the reason people buy term is because it's the same thing like renting an apartment. When you rent an apartment, you do it because it's cheap, right? So we get started renting because it's cheap. What's the problem with renting long term? Rents are only going to go up. When you're done renting, what do you get back? Thank you for being a good renter. Thank you for being a good tenant. Hopefully left your property in good condition so you get your security deposit back, right? That's what you've got. It's the same thing as renting. Whereas a max funded policy, it's similar to owning. Isn't a mortgage far more expensive? You got your down payments, you got your points, and everything else. And your payments are often higher. Not always true in every market, but your payments are often higher to get started with. With your mortgage, especially if you have a 15 or 30-year mortgage, again, we would recommend a 30, not a 15, but your payments are level. Can your payments go down? And not necessarily. They'll eliminate once the mortgage is paid off. You could refinance. That's a whole different thing for lending, though. But after a long period of time, don't you have enough equity built up in that policy, in that home? You've built up home equity based on the property value, which is not in your control, and you could borrow against it if you qualify. Very similar. And then in the middle for the hybrids, it's more like a manufactured home or a condo. It's in the middle, generally speaking. Payments will probably go up. You get your HOA, that's for sure. And yeah, payments will probably not go down. Will you get all your money back? Depends. So why would anybody buy term? It's cheaper. And structure. And no, I think I'm connected here. So
yeah, we lost you for a second. I was about to take over because your face was just staring at the board, and I was just going to take over and explain a couple other things. But you came back, so we're good.
Okay, so what did I leave off at?
No, all I would say anything different. With term, it's basically the idea is that maybe you want to use a term to protect a mortgage or something like that for X amount of years, or you have a business agreement potentially, or you have a short-term debt or even a long-term debt or something that you want to cover for X amount of years, right? And so that's where a term can be really beneficial because it's going to cover that whatever you need covered for that amount of time. And then at the end, you're done. And maybe that asset's paid off or whatever else has happened. But so, and it's going to be very inexpensive and cheap because it's a term policy. So,
right.
So
Daryl says that whiteboard presentation looks familiar. Yeah, Daryl, you know where I got it from. Great way to explain the concept between term and permanent. Thank you very much. Appreciate that. And this is just high level basic. Alonzo asks, could one buy ROP term, albeit crazy expensive still? That's a hybrid. So it can be done. Does it still make sense? I remember quoting, this is years ago, I was quoting a Mutual of Omaha return of premium term. It was like 5 times more expensive. I'm like, who in their right mind would recommend that? I mean, I'm glad to do the quote, but
yeah, I mean, that's pretty high. I would say that generally speaking, it's going to be at least twice the cost of a regular term policy. Just as
it used to be years ago, like maybe 20 to 30% more. So it's just a little bit more because you put a little bit more to get all your money back. That was the idea. Now, if we think about this, we're going to think about this a little critically. ROP term is a cash value life insurance policy for the insurance company. Because we're paying more premiums, but we don't get the benefit of cash values.
Now, there is one benefit that I, could mention with the ROP term or return of premium,
Okay.
is that at the end of the term, instead of taking your money back, oftentimes the insurance company will allow you to use that to purchase what's called a reduced paid up whole life insurance policy, where those premiums just go straight into a whole life policy that's already paid for, that has a death benefit attached to however much the premiums were that you paid into it. So there can be some benefit to it if you want to decide you want to go ahead and use it for that purpose, and then you can use it to. And the insurance company has to allow you to do that, of course, not necessarily all.
It's just got to be
ROPs
built into the policy,
right? Yeah. But that could be a benefit to it, is that you're putting this extra money into it. You still have the term insurance, but at the end, you're either going to get your money back, or you can use it to buy a reduced paid up policy and have whole life insurance for the rest of your life that's already paid for. So there can be some benefit to it.
Alonzo asked a very interesting question here. How many life policies can one person have? As many as they can be underwritten for, and the justification for the purchase of them. I think I remember hearing, was it, just escaped me. I hate it when that happens. Who wrote the Infinite Banking book? Nelson Nash. I think he had like 63 policies. If they could be approved, and you can have all kinds of different reasons for being approved, and that doesn't include business reasons. So you have your personal stuff for your personal income, but then you have your estate planning stuff. Then you have your key person that's on you. There's all kinds of things. The question is, does it make sense?
Doesn't Joe Biden have like 6 Mass Mutual policies or something like that? I heard.
Yeah, I've got the document. It's the federal, the financial election disclosure, ethics disclosure. I have that. Yeah, he's got like 6 policies. And I've been told that I might get a chance to meet Trump's insurance agent. Has not yet happened. That would be pretty cool. And if I could get him on here, that would be a very interesting podcast. I've been told that. It's been at least 6 months since I've heard anything about that. So, Professor, if you're watching, I haven't forgotten. Okay. Now, I want to kill one of the biggest myths about life insurance.
Let's obliterate this thing, because I know where you're going.
You know where I'm going? Okay. The biggest myth out there, and there's so many people that get this so wrong, including and especially insurance agents. Shame on them for not realizing that this was taught in their licensing class. But the myth is, does the life insurance company keep my cash values and only pay the death benefit? We're going to do this again, class. No, okay. No, I've got a new class this time. It's been 4 years since I did that last video, but we're going to look at this. This is a box. This is your policy. This is your policy on drugs. No, that's okay. We're going long now, and now I'm starting to get a little hamming it up. But if this is your policy, I want you to think about this from year 0 of the policy. You're getting the policy started, maybe 5, 20, 50, whatever. It doesn't matter. And you're getting started, and you're going to fill up this policy of cash values. This is what these lines mean. This is the death benefit. This is your cash value. What's this? The difference. It's called the net amount at risk. And I'm going to put, piracy, right? Okay. Anyway, and over here, I'm going to call this a policy loan, because you can borrow against the cash values as you're alive, whatever that loan size is going to be. It's repaid by the death benefit when you pass. But let me go over the calculation here. The net death benefit equals cash values plus net amount at risk minus any outstanding loans. And it doesn't matter which time you pass away. The equation always works 100% of the time. The math is always there. I don't care if it's option B, option A, or C, D, E. whatever, it doesn't matter. This is the way life insurance works. It could have an increasing death benefit. It still works the same. The cash value is a component of the death benefit. It is not on top of, but it's a component. It's included all there. Now, here's where, I mean, first of all, the reason why this gets confused so much is because they forget about this net amount at risk. There's no column on the insurance illustration that says, here's the net amount at risk. You're supposed to do the math yourself. And there's too many columns on that thing anyway. So that's one reason why it's confusing. The second part is if anybody understands insurance company operations, they actually don't want to pay the reserve. They don't want to pay the benefit out of reserves. They want to pay it from new cash coming in. So that's one reason why they may be thinking that, well, they're going to keep the reserve and we're going to pay it out of cash flow. That's a function of the insurance company. That's not a function of the policy. This is how the policy works. You're going to get the whole benefit minus the loan because you already received that. But that's how that works. Whether the insurance company operations, however they do it, you don't care. You get the check, or the beneficiary gets the check of whatever you're entitled to. So it is factually, economically, legally incorrect to say the insurance company keeps the cash values. The insurance companies don't print money. That's the federal government's job. So along, especially those IULs, the illustrations are often 40 pages long. Exactly. They're so long. And so in a way, I don't fault people because the information is not that common, unfortunately. And so my goal is to get that calculation out there. Net death benefit equals cash values plus net amount at risk minus any outstanding loans. That's the formula for life insurance. And I can usually tell a huge amateur who doesn't understand that because they're going to keep quoting the old garbage. And sometimes I find some that are just so messed up in the head that I just like the answer doesn't matter for them. They don't care to learn. So that
and most of them
they're usually with a particular company that starts with a P and ends with America.
Yeah, you said it.
Yeah, well, close enough. All right. But it's also one reason why I turned off the comments on that video because I kept getting comments from idiots that just kept saying, this guy is so messed up. In fact, I had comments on Sanjay Tolani's explanation between term and whole of life policies. And like the guy does millions of dollars of commissions a year, and he's not doing it unethically. The guy knows his stuff. If you know how to serve your clients well, you can do fantastically well in this business. GC, man, I wish I knew your actual name. I know it's not Grant Cardone because you chimed in before. Am I still with the Breakaway League? I am not with the Breakaway League. I am very much to the side of the Breakaway League. Let's put it that way. I still believe everything we've been taught. Here's the thing is that if Tom wants me to help out with promotion and stuff like that, I'm always open for that. Haven't heard anything from him on that in quite a while. But at this point, I'm working on some big projects. And so that is taking up all of my time. But it's worth it. That's what I tell myself. Okay. I think we covered it. By the way, for other YouTube videos that I happen to really like, I'll just say them. Guy Baker, The Box. Guy Baker, legend in the business. In fact, I'm going to meet him tomorrow for the first time. He's presenting at the NAFA Business Owner Planning Summit in San Diego. He's presenting, and I know someone's going to introduce me. So Guy Baker, The Box, just search for that on YouTube. Fantastic video. That is, even goes through the actuarial process of how life insurance is designed and the assumptions behind it. So it's really in depth. It's very, very good. The second one, and you can always do a search for, it's called The 10-Minute Lesson on Life Insurance, which is a little bit longer than what I went through earlier, but it goes over, why would anybody in the right mind, buy cash value life insurance? And if the policy is structured well as a, they call it a maximum, what do they call it? I haven't watched that video in a while. It's up to the MEC guidelines. So remember, MEC stands for Modified Endowment Contract. Endowment contracts are now taxable, but we want the most efficient contract up to that limit. So it's a maximum efficient contract. Yeah, I think that's what they call it. But there's a great video on YouTube on that. It's about 10 minutes or so. Very, very good. And it shows why would anybody do that? And there's a whole list of I think there's 13 different line item benefits for why someone want to do that. And here's the neat thing that I love talking about. This is what I got for the breakaway league. How you can have less money in life insurance and have it be far more efficient for your retirement purposes than having 3 to 5 times as much in a 401k, IRA, or any other IRS qualified plan. What I learned that I love that. And I think I've shared that on here before. I was in a private briefing, I don't know, a couple of years ago. It was regarding private placement life insurance. There's a whole nother level. And with private placement, it's based on investment growth. And afterwards, I'm meeting the presenter and said, so what do you do, David? I show people how to use life insurance for retirement purposes. And, so what do you use? I use a whole life policy, 10 pay. He asked me, what's the rate of return on that? I said, oh, it's negative. But I owned that. I was not ashamed of that. I wasn't put off by that. I was waiting to see his response to me saying it's negative. Because you can actually have a little bit less money at the end of the 10th year than what you put in, and yet it'll be far more efficient. And then, of course, what I expect to say, well, imagine if you can bring in 7.5% a year. And yeah, I know. But that only works for certain types of people. So anyway, I love being able to have proper expectations because the return in life insurance sucks. But if you know why you're doing it and all the advantages of it, it could be magic. So I think I've covered that topic to death. Can you think of anything I might have missed, Mike? I mean, we're at almost an hour and a half here.
Yeah, no, there's more that we can talk about, but this is getting a little long, so I think we can wrap it up for this one. But if you want to do more of these, educational videos, I mean, heck, we could do one of these podcasts on almost everything that we covered, just a separate podcast for them, right? So this is
why do you think that business owner course is taking me so long? It's so
right. So this is just a very basic, high level overview of everything. Hopefully to give you some, pointers and ideas and whatnot about different insurance coverages and how they work. But like I said, we could go much more in depth on all of these things and maybe take an hour podcast on almost each and every single one of them. So, this just hopefully helps people get some basic knowledge and understand some things.
Yeah. So I'm glad to give you something to watch there tonight, Alonzo. Dave, you got to give a course on that. So many of us are willing to pay to learn that. Hey, I'm including all of it in, before I.
Hey, Alonzo, just show them this video and find out where the timestamp is and send them the video. And it's free.
Well, that's part of it, but I'm going to go into far more detail. Daryl, glad you're chiming in. I've got that business owner course I'm working on, and so far I think it's going to be about 40 modules. And part of that, I'm going to take about 3 of them, and we're going to talk about cash value life insurance specifically on that, not even including using it for buy-sell agreements, key person coverage, executive comp, all of those things. It's going to be so in-depth, which is one reason why I'm taking a long time, because it's not just learning it, it's learning it well enough to teach it. And so the good news is I think I can communicate it in such a simple way once I figure it out. That's the hardest part. I have to figure out how to make it simple so I can teach it. The good news is the challenge is there, and I'm willing to take it on. But man, does it take a while.
That's the MISS method. Make it simple, stupid.
I thought it would be the KISS method. Keep it simple, sweetie. But yeah, got it. We're working on that. So anyway, gentlemen, thank you so much. Thanks for chiming in. You're making it active and such. We've had quite a few people chiming in. We'll be back again next week. Same bat time, same bat channel. And we'll catch you all next time. Thanks so much for watching, listening. Make it a great day. Yeah, like, share, subscribe. Do the things. You can't comment anymore. I've turned off comments because I keep getting spam. So anyway, but do all the other things you can do. Catch you all next time.
You have been listening to an episode of the Financial Advocacy Podcast. As a reminder, you can't hold us accountable for any actions you take on your own. Just like all financial entertainment shows, we are not providing legal, tax, or securities investment advice of any kind. We do provide general investment information for educational purposes only, and we will discuss alternative financial strategies that do not contain or include securities. You can view all of our disclosures and disclaimers at our website at www.financialadvocacypodcast.com. Look both ways for across the street. Thank you for listening, and make it a great day.